All right, for chapter 26, maybe I'm being a little lazy, but I'm going to use the canned slides that come with the book. Part of it is because chapter 26 is not a lot of math. There's not a lot of complexity to it. It's mostly just reading, and I didn't want to create a bunch of slides that just repeated what the book says, because I think the book does a pretty decent job. So what we'll do is we'll blow through some of these slides. I have added one or two of my own where I thought they were needed. I'm not going to spend a lot of time on how the IRS is structured. You can take a look at that for yourself. I guess it's utterly fascinating. I'll let you worry about letter rulings and other issuances. I think one of the parts that's most shocking, if you will, is take a look at what the cost of a letter ruling is. Even if you're a low-income taxpayer, take a look. I think those amounts are shocking. I won't say what they are, but that's on page 26-4 of the text. I won't worry too much about the administrative powers of the IRS. Burden of proof is something where this is what's particularly relevant. If the taxpayer meets the burden of proof on record keeping, then the IRS has to establish the burden of proof for a deficiency. So this is a situation where if you have documentation, you're in good shape. The burden of proof is on the IRS. If you don't, then they can simply create a tax return out of thin air and say, well, this is what we think you owe. And then the burden of proof shifts to you to show that that's not what you owe. So, this is where accountants also establish our value is, for a classic small business, they're really not that interested in keeping books. So hiring a bookkeeper or an accountant or a CPA to do that for them can be valuable. I won't get into assessment and demand. Those rules are super important. The good news is we teach a course called Accounting 655. If you're really interested in tax controversy and the audit process, that course is devoted. Well, half of it is devoted to that topic. So I would encourage you to take that course along the way. And you'll learn more about the audit process there as well. The important thing maybe to understand about audits is, we don't really have a perfect idea as to how the IRS picks audits. We have some hints, but we do know that they do use formulas to determine if there's errors, right? So there's matching systems. Not everything's matched, but it probably would come as no surprise to you that the wages that are reported on your W-2, there is an attempt to match those up against what you report on your tax return. And as long as the amount you report is equal to or greater than what's on those W-2s, that generally is not going to raise a red flag. So that's the sort of checking. And of course, like if A plus B is supposed to equal C and yours doesn't, then you might get a audit. An audit is a pretty harsh term for what happens. It's really a correspondence audit where they send you a letter and it says, hey, we identified an error on your tax return. If you agree, either pay or your refund's coming. If you don't agree, send us a letter and let's get started on the assessment process. So most audits are started about 2 years following the date of return is filed. That's true. The IRS, this is especially true now. They are so far behind, and their budgets have been slashed, and so they've really been struggling to keep up. As you probably know, I run the VITA program, or I've been running the VITA program here at San Diego State. And we paper file because we have a lot of non-residents that aren't eligible to e-file. And the IRS is literally saying it could take 6 months for them to process. And so that paper return. And so, wow, they're just buried, and COVID didn't help. Okay, so there are some probabilities that we can see just based on statistical evidence that is provided by the IRS, which is you're far more likely to be audited if your income's higher. No big surprise there, right? If you take 100 people that make $200,000 and you compare that to the tax that's paid by one person that makes $200 million, the IRS is going to get so much more recovery out of the audit of the 2 million person than they would all the people who make 20,000, and so they do in fact do that. They spend some time on self-employed individuals, and that's largely because of something called the tax gap, which is this idea that a wage earner has a much more difficult time of omitting income or, well, and frankly boosting deductions because the only deductions they get are itemized deductions. Whereas a small business that's reporting on a Schedule C, um, that's more ripe for abuse because there's no W-2 to tie it to. So the tax gap, I want to say recent numbers are somewhere between 80 and 90% of that comes from small business owners who aren't reporting all their income or are inflating their deductions or simply reporting personal expenses as deductions. And if you ever spent any time looking at tax court cases, you would see many, many, many of them relate to those situations. And cash businesses where the potential for evasion is high, they try to look at, but those often are actually low dollars. But when you think about high dollars, casinos, things like that, where money can be laundered as well. So it's got the government has a double prong to try to audit those folks that are big into cash because they could be not reporting their income. They could also be laundering money. Okay. The probability of selection, if the information returns aren't in agreement, that's that matching problem we discussed. Itemized deductions are in excess of norms. That's the red flag system, if you will. There's this thing called the DIF system. And, like it basically says, okay, for someone at your income level, we would expect your mortgage to be X. When it's X plus a whole lot, then they say, okay, well, let's throw up a red flag on that. And there's a scoring system. So they would say, oh, that's worth X points. And if you get enough points, they select you. And then the other thing that happens is they just see it, right? It's in social media or it's posted on the news or something where it doesn't make sense. And whistleblowers, right? People who just call up the IRS and say, hey, my neighbor's not reporting their income, but they're rich. You should definitely be chasing them down. In any event, the audit rate is just obscenely low. It's much less than 1% for all individuals as a group. Again, it's higher than 1% if you're affluent. Yeah, there's awards available, whistleblower awards, if in fact it turns into a big recovery. So the most common is correspondence audit. That's that letter, right? So, hey, we noticed that you didn't add lines 2 and 3 together properly. E-filing remedies a lot of those, right? Because the e-filing systems generally all have mathematical checking as part of them. And so an e-filed return is much less likely to have an error of that nature. The matching problem is a correspondence audit. Hey, we noticed that you reported withholding, but you didn't submit a W-2, that sort of thing. And you just get a letter, and it says, hey, this is what we think. Either agree or send us a letter that you disagree. Office audits, wow, like so rare these days. COVID really tanked them, of course, because no one wanted to be near anyone. And so these are ones where it's more likely to be a small business, and they're going to come in and say, okay, let's establish what your deductions are. Let's establish what your income is. Little more invasive. Field audits are the most invasive. This is when, hey, we're coming to your place of business. We're going to sit in your business. Large companies, certainly Fortune 100 and 500, the auditors are probably there every day. They probably have their own conference room and their own file cabinets, and they just sit there every day. So let's talk about penalties. And there are many, many, many of them. I want to focus on a couple of them. Either because they affect lots and lots of taxpayers, even though they're not very big, or they affect tax preparers. Most penalties that are big are there, as a warning, like, hey, just don't screw this up and you're going to be fine. So penalties can involve criminal and civil offenses. Criminal penalties, that's like fraud. You could be fined and go to prison. Most penalties are just monetary. A lot of times they focus on areas that the IRS knows that taxpayers abuse. And so what happens is they say, look, we know you abuse these. So what's going to happen is if you get caught, we're really going to hammer you with a penalty. That's like a good enforcement system. There's plenty of research that shows that that's an effective way to do it. Okay, so let's start with the two that we see a lot: failure to file a tax return and failure to pay tax. And let's start with a file a tax return. It's 5% of the amount of the tax that's due, up to 25%. So, for example, if you don't owe tax, potentially you pay no penalty at all. So, hey, I don't owe tax. I'm actually due a refund. I never filed my return. So what? IRS is happy to keep my money. They're far more concerned if you owe money. There's a minimum penalty of $435. So, and that number is adjusted for cost of living, and it has ratcheted up. So, especially with e-filing, the IRS is considerably less complacent about the need for someone to, take extra time to file a return and not file an extension. I mean, come on, if you file an extension, it's automatically approved, and you have until October. Like, how could you not get this done in 9.5 months? So those penalty rates are considerably higher. If failure to file is due to fraud, the penalties go way up, right? 15% a month up to 75%. And there is a cap on that previous one of 25% of the tax due. Failure to pay a tax, this isn't exactly what it sounds like. This is failure to pay all of the tax that is due by April 15th. So what that means is, again, most of us are wage earners, so we're paying throughout the year through withholding. This is, but you didn't pay enough. So whatever was due that you didn't pay by the due date, which again, for most of us, April 15th, that's 0.5% per month, again, up to 25. And what happens is these two actually work in tandem. You take the failure to pay and add it to the failure to file, and the maximum is the 5 and 25 under failure to file. So it's never really more than that. Okay, because a lot of people who don't file also, don't pay, of course. So we discussed this already. Filing an extension doesn't give you an extension to pay. There are always there's almost always a reasonable cause exclusion that you can try to claim, like my house burned down, come on, give me a break. That's reasonable cause for you not to have paid your taxes. Reasonable cause found where taxpayer worked with a competent tax advisor, right? So, my CPA didn't say I had to. Oh, okay. That's called falling on the sword. CPAs do that quite a bit in practice, right? So it wasn't really our fault, but we're like, hey, if I can get you out of the penalties, why not fall on the sword? What happens is the IRS keeps, if you will, think of it like a dossier on tax preparers. And if they see many not fraudulent claims, but if they see problems with a particular preparer, then they come in and talk to the preparer. Hey, what's up with, 80% of your clients filing late? And you're taking the blame. And unless you've got reasonable cause as a preparer, they're going to drop the hammer on you. Let's see. Accuracy-related penalties. These are ones where you just didn't report the right tax, right? So 20% of the portion of tax underpaid. If it's negligent, there's a substantial understatement, a substantial valuation, overstatement or understatement. And valuations are this hairy area, right? So, I have to establish what the fair market value of my trust is, for example. Well, I think it's $1, right? Well, wait, you own 46 buildings. How's it $1? So, because valuations are subjective, basically the IRS says, look, if they're big, if you missed it by a lot, we are going to drop the hammer on you, unless you can show a reasonable basis for that position. Accuracy-related penalties, negligence includes disregard and applies except when there's fraud. So, when fraud comes into play, think of it as it's a different set of rules. These are kind of the measures of substantial understatement. I'm not going to read through those. I think they're self-evident. One of the important things for substantial understatement, and I will highlight this, is if the taxpayer has substantial authority or there's a reasonable basis and it's adequately disclosed, then that penalty doesn't apply. And so what we're going to see is when we get to tax preparer, penalties, not taxpayer, but tax preparer, it's all about substantial authority. So, so we'll spend a little more time on that. Again, here's the overvaluation and the undervaluation of assets. And, the idea is we'll give you some wiggle room to be wrong when it comes to valuation, because that's kind of the expectation. But if you're wrong big, then we think you're just, flaunting the rules. This is where the appraiser's penalty comes into play. Like if you relied on an appraiser, then the appraiser can also pay the penalty, like for committing fraudulent appraisal of those values. Improper refund claim, this was a scheme that happened, and so they had to shut it down. All sorts of people were filing improper claims for refunds, so they'd file a return right away, and they'd be like, I had zero income, but they withheld $20,000 from my pay. And the IRS's automated system was just giving that money back. So they had to ramp up the penalties to try to stop that sort of behavior. Fraud is fraud again. I'm not going to dig in on fraud too deeply with the penalties. I do want to talk about failure to pay estimated taxes. So this is another one that affects way too many taxpayers because they just don't make those estimated tax payments, and they don't make them on time. So either not in the right amount or not in time. So you can see there's no imposition of the tax if it's less than $500 for corps or $1,000 for all others, including individuals. So if your taxes, the tax due that you have to pay by April 15th, remember that failure to pay penalty, that's if you didn't pay it. This one is, well, don't forget, you're actually supposed to pay your taxes during the year. So if you get to April 15th and you owe more than $1,000, then you failed to pay proper estimated taxes. And you're actually going to have to pay penalties and interest on the fact that you didn't pay enough during the year. And we'll work through what those are, but and I'll give you some examples when we do the corporate chapter. Quarterly estimated tax payments are required on the 4th, 6th, 9th, and the first month of the following year for individuals. Corporations actually make it in the 12th month, so they make it before the year end is over. And the payment's expected to be 1/4 of the tax expected to be due. And when you underpay, there's this form called a 2210, and it kind of breaks your income down ratably into the 4 quarters, and it compares it to the payments you made. And if you didn't pay it ratably, you're going to be in trouble. So this is an instance where you can get double whammy. Number one is you didn't pay your taxes in enough amount, and you didn't pay them on time. So there is a safe harbor for not owing the estimated tax payment. So first is you got to pay the lesser of 90% of the current year tax or 100% of last year's tax. So it's like, well, look, I paid in what I owed last year. I certainly thought that was going to be enough. Okay, well, if that's less than 90% of the current year tax, that's going to work out. If your AGI is higher, though, the idea is, look, you're a more sophisticated taxpayer. You have to pay 110% of prior year in order for the safe harbor to apply, and there'd be no penalty for failure to pay estimated taxes. And high AGI is considered 150,000 for this particular rule. Or you can pay 90% of the tax on an annualized income basis. There's a cool calculation for that. And again, I'll show you that when we get to corporations. Corporations have slightly different rules. They don't get the 90%. It's basically 100% current year tax, 100% prior year tax, or this tax on annualized income. And there's rules for short years, and there's rules for if you're a big corporation. Again, the idea is, look, if you're a big corporation being measured as taxable income of more than $1 million, then we think you're sophisticated enough. You shouldn't be screwing up your estimated payments. False information with respect to withholding, that goes back to that same scheme that we talked about where people were just filing fake W-2s. A few years ago, you could just download a blank W-2 and put whatever you wanted on it. I would encourage you, just as for funsies, to go out to the IRS website and download a W-2. And what you'll see is you can't type in any of the boxes anymore. So the purpose of that was to try to make it a little more sophisticated for people to fake a W-2 because they were doing it. Failure to make deposits of taxes. This is your employment taxes. Again, you can see there's just a penalty when you don't pay. That penalty could be pretty severe because think of it, what you're really doing is failing to pay your employees withholding. So you've taken the money out of their paycheck, but you didn't turn it over to the government. Yeah, that's a real problem. And then when it comes to tax shelters, the penalties are always huge. It's like you play with fire, expect to get burned. Okay, I'm not going to spend too much time on criminal either, right? Burden of proof is on the IRS to show that you've committed a crime, a full-blown crime. Many times that's either conspiracy or it's full-blown unadulterated fraud. Okay, so what governs the practice of CPAs? Well, and I shouldn't say CPAs. What governs the practice of individuals who, and the magic phrase is practice before the IRS? So that's generally CPAs, attorneys, and enrolled agents. Like an enrolled retirement plan agent can qualify, but basically it's CPAs, attorneys, and enrolled agents. And what happens is they can represent a taxpayer in front of the IRS. That's it. This doesn't have anything to do with preparation of the return. So Circular 230 has never been updated since there was a court case that said, hey, tax prep doesn't fall within Circ 230. A taxpayer can always represent themselves before the IRS. That makes perfect sense. Full-time employees can represent their employers. So that's kind of like, hey, the director of tax can represent Qualcomm. Yeah, that makes sense. An officer can always represent a corporation. Partner can always represent a partnership, et cetera, et cetera. Notice that the taxpayer can only be represented by whoever prepared the return, but that's only through the agent level. So that's never in front of the court. So that gets you through the IRS agent, but then once you get to appeals and above, that's practicing before the IRS, and tax preparers, unless they're CPAs, attorneys, or enrolled agents, aren't eligible for that. What the IRS does require is that all tax preparers, paid tax preparers, have a P10. It's actually not that hard to get, but again, that's what they use to prepare your secret file against you if they see a common pattern of errors, or they're seeing like, why is everyone who's reporting getting giant refunds from this particular CPA? Wow, that's weird. So the P10 is all they really have. Circular 230 says that tax practitioners should be competent. No surprise there. They shouldn't engage in willful or reckless behavior. They shouldn't sign a return that includes a position that could be subject to a preparer penalty. And now we know what that is, right? It doesn't have substantial authority. And they certainly shouldn't be taking frivolous tax positions. You can read this. That's Circ 230. If someday you're interested, you can download Circular 230. It's actually a Treasury regulation. It's updated about once every 10 years, which isn't frequently enough, but that's what it is. There are some what I would describe as best practices within Circ 230, right? Use due diligence. Yeah, no kidding, right? Don't unreasonably delay matters. Don't charge unconscionable fees. These are really more intuitive than anything. So California has its own. We're one of the unique states that we regulate tax preparation under what's called the CTEC program. CTEC requires that you're 18. You have to get bonded. The bonding's like contractors, so that means if you fail for some reason, they can pursue against you. And you have to go through 20 hours of training every year, 15 at the federal level and 5 at state. And there are certain education providers online or in person that are certified to provide CTEC training. And once you get those, you are then eligible to prepare tax returns for money in California. So preparer penalties, obviously these are here so that tax practitioners can also be penalized if they're misbehaving on the part of their clients or providing bad advice over and over and over again. There are a few people that can escape that. I'll let you read that. Penalty for understatement due to taking an unreasonable position. And what is our safe harbor? Again, I'll mention it again, substantial authority. So this 40% chance, don't walk away thinking like, oh, if I have a 40% chance, I'm good. Those are not hard numbers, right? 40% is kind of like, well, might be between like 30 and 50, really. So, but the idea that it would be sustained on its merits if it were reviewed. And that's substantial authority. If you don't have substantial authority, but you feel like there's a reasonable basis, then you can disclose that position and avoid penalties. It's like, hey, look, we're not sure whether this is right or not, but we think there's a reasonable basis for this position. So let's take it and disclose it on the tax return. And the worst that can happen is like the IRS looks at it and says, well, we don't think it's reasonable. Okay, well, you either go to court or you pay. So, and you can see there's a penalty that's greater of $1,000 or half the income that you made off that return. So again, it's just worth repeating the substantial authority rule. And the code section that covers that is code section 6694. 6694 covers preparer penalties. 6692 covers taxpayer penalties. This is what it means to have substantial authority. I'm not going to read all these, but these are all basically sources that are considered primary source materials for tax law. So if you have something in one of these that says it's okay to do what you're doing, then you have substantial authority. Things that you see outside of that, those are not substantial authority. So your textbook, or hey, I got a legal opinion. Well, that's great. Be prepared to sue your lawyer for malpractice because that's not substantial authority. Okay, the understatement, if it's willful, that just gets the penalties ramp up, and they ramp up pretty dramatically. So again, not going to spend a lot of time. These are what I would describe as minor penalties, where like you're forgetting to do something important. They would really only ramp up if you were making a habit of it. So, oh, you're not signing the returns, but you're being paid to prepare returns. Okay, that's a problem because you probably don't have a PTIN, right? So you're doing something hinky. You're not practicing the way the IRS expects you to. It's only $50 for each one, but obviously if you had a pattern of that, then they'd come after you for one of the more severe fraud or conspiracy penalties. Okay, so if you are a member of the AICPA, and only if you are a member of the AICPA, if you choose not to be a member of the AICPA, their rules do not apply to you. But if you are, they have 7 statements on standards for tax services. Lots of CPAs are members of the AICPA. It's a useful organization to belong to. I know I did all my years as practicing, and my employers always paid for it. So you can take a contrary position, but at least it has to have at least a realistic possibility of being sustained. It also says that, this feels old to me because it actually says that it needs to be consistent with what the jurisdictional law is. So if you're filing a U.S. tax return, income tax return, the standard is substantial authority or reasonable basis with disclosure. That's what the standard is for the AICPA as well. Questions on returns basically says you should answer all the questions on returns. Don't when the question says, do you have evidence to support this deduction? You can't just be like, don't check anything, because then they won't know, right? This is a rule that says no, check the box. If they have it, check yes. If they don't, check no. Procedural aspects of preparing returns. You do not need to audit your client's information or information provided by a third party. So your client walks in and they say, hey, I have charitable deductions of $1,000. And you're like, well, do you have evidence to support that? And he's like, oh, no, but I have this list, right? Or I said, church and United Way and whatever. And they all look pretty reasonable. And that's good enough, right? That you're not required to verify it unless it seems to be incorrect. So let's say that taxpayer's 15 years old and made $7,000 last year. Okay, wait, does a $7,000 15-year-old make $1,000 worth of charitable contributions? That seems inconsistent, and I'm going to need to know more because otherwise I'm not exercising the type of due diligence I should. You can use estimates, right? So sometimes estimates are used. You should avoid the impression of greater accuracy when you do so. That makes perfect sense. Recognition of administrative proceeding or court decision. So what this means is if a decision came down against client A And then client B had a similar but not identical situation. You are not bound to follow the same rule for client B that you did for client A, though you should be prepared to document why you've deviated. What are the differentiating factors? And it doesn't even have to be client A and client B. It could be client A in year one, and then client A in year two, but you come to a different conclusion. So basically, you're supposed to consider that history, but you're not bound by it. If you know of an error, your task is to notify the client, explain the consequences of not fixing it, and then you're done. If it's egregious enough, you might consider disengaging from that client, but you're frankly not required to. You shouldn't, of course, sign it if it's this year's return because of all the prepare penalties that we just walked through that are associated with that. So this, I think the tricky situation on this one is you're in year two and you're doing your client's tax return and you notice an error in year one, but you prepared year one. And now you have to face down your client and explain to them that you made an error on their return and they're actually going to owe more money. That's where the diciness comes from, but you're required to do so. And of course, you should always use competent judgment when communicating. And really, the rule here is you should communicate in writing to the extent at all humanly possible. This was a much bigger deal pre kind of the email era. When it was like, oh my God, I got to write a letter that explains everything I did for the client. Now you can just shoot off an email and that counts as written documentation. Okay, that brings us to the end of 26.